Hello everyone, so incredible to be with you again. Today we have an exciting one for you because I'm going to be breaking down the Bitcoin Corporate Financial Framework and explaining each term so we can get these lollygagging board members on board, pun intended. My name is Adam Livingston and I am your #1 source for Bitcoin and Bitcoin Treasury company analysis. Please, if you find this information helpful, subscribe to the channel, like this video, and leave a comment on what you'd like me to cover next. Alright, let's break down the BTC Financial Framework because if you're going to run a Bitcoin Treasury company, you need more than vibes and a ledger wallet. Let's start with the BTC KPIs. That's key performance indicators for those of you who skipped your MBA to trade altcoins. These are how we track whether or not our Bitcoin Treasury strategy is actually working, or whether we're just LARPing as a sovereign wealth fund. Number 1, BTC yield. This is your Bitcoin per share growth rate, not in dollars, in actual sats per share. If this number isn't going up, you're not stacking, you're just cosplaying as a Bitcoiner while burning shareholder equity like incense in a cargo cult. High BTC yield means you're increasing everyone's share of the Bitcoin pie without printing more pie. If Satoshi were watching, this is the metric he'd be whispering about in a candlelit temple. Number 2 is BTC gain. This one tracks the raw amount of Bitcoin you've acquired, but only when you did it without selling your soul. BTC gain is like stealing fire from Olympus without selling equity to the gods. You didn't print new shares, you just got the bag. It's the difference between running a treasury like a sovereign wealth fund or like a panic-clicking Robinhood intern. Number 3 is BTC dollar gain. Now we translate that same BTC gain into USD terms so normies can understand what's going on without panicking. This is useful if your board still thinks in fiat. You can walk in, drop this number, and say, yes, Cheryl, the Bitcoin went up and we didn't dilute. No, it's not a pyramid scheme. So to summarize, Bitcoin yield equals how much each shareholder's slice of Bitcoin grew. BTC gain is how much Bitcoin you stacked dilution-free. And BTC dollar gain is what gain looks like in fiat clown money. So you can explain it on CNBC with your CFO. If you're a corporate Bitcoiner, these are your sacred scrolls. If you're not tracking these, you're not running a bit strategy, you're doing performance art. All right, we've measured how much Bitcoin you've stacked. Now we're going to measure what it's worth and how efficiently you conjured it into existence. This is where we enter the dark art of Bitcoin valuation, which is a bit like alchemy if the Philosopher's Stone was priced in sats and audited by the SEC. Number 1, Bitcoin dollar income. This is the income generated by your BTC gains after you pay the fiat goblins, dividends, interest, or whatever other fiat-denominated blood sacrifices your company made along the way. It tells you whether your Bitcoin position is just sitting there like a stoned teenager or actually generating net value. If dollar income is negative, you basically paid $20 million in convertible note coupons, so your treasury could watch number go sideways. Bravo. Number 2 is Bitcoin dollar value. This is the cumulative USD value of all your Bitcoin gains plus the income it's generated. Think of it like your corporate treasury chest. If you're doing it right, this number grows faster than your CFO can refresh the Bitcoin chart on his Bloomberg terminal. If you're doing it wrong, it looks like your company just bought internet tulips. This number is your scoreboard. If this isn't rising over time, something's broken, probably your Treasury Committee's brain. Number 3 is BTC dollar equity. This is your BTC net asset value minus your BTC dollar value. It's the fiat equity that hasn't yet been translated into Bitcoin value. Said differently, this is how much shareholder blood is still sloshing around in the system unredeemed. It's like holding a golden goose and only eating the feathers. Low BTC dollar equity means you've already turned most of your issued equity into pure uncut Bitcoin. High Bitcoin dollar equity, you're still halfway between a VC pitch desk and a financial Valhalla. BTC torque is how much value you created per dollar invested. High torque, you're the Elon Musk of capital efficiency. Low torque, you're a congressional budget committee. And BTC multiple is the big one. It tells us how many dollars of BTC NAV you've created for every dollar of equity you've issued. A high BTC multiple means that you run your company like a weaponized sovereign wealth fund. A low multiple means you're trying to mine Bitcoin by rubbing fiat together and praying. Now we enter the final boss of Bitcoin financial analysis, BTC credit. The part of the framework that separates sovereign-grade balance sheets from the altcoin-era CFOs praying their bonds don't go no bid. We're not just stacking anymore, we're asking how dangerous is your capital stack? How likely is your debt to implode in a puff of fiat smoke? Let's break it down. Number 1, BTC rating. This is your Bitcoin native credit rating. We take your BTC net asset value, basically the value of your Bitcoin vault, and divide it by total liabilities, including anything short-term or senior in the capital stack. In simple terms, can your Bitcoin cover your debt? If yes, you're a sovereign black hole with capital. If no, you're a walking margin call with a LinkedIn bio that still says innovator. It's Moody's for Bitcoiners, but instead of AAA, your rating is either Fortress of Hard Money or one bad tweet away from a restructuring. Number 2, BTC Risk. Now we calculate the probability your liabilities are under-collateralized by Bitcoin. This isn't theoretical. If your BTC Treasury value drops and you've issued a note backed by Vapor, congratulations, you've invented crypto subprime. High BTC Risk means you're a ticking debt bomb waiting for a red candle. Low BTC Risk means even if Satoshi himself sells, you're still bulletproof. Think of BTC Risk as your financial radiation level. Too much exposure, enjoy your mutated credit score. Number 3, BTC Credit. This is the credit spread you need to convince someone to lend to you despite the above risk. It's how much extra interest you've got to offer because the lender doesn't want to wake up at 2 a.m. refreshing the BTC chart and crying. If you got a strong BTC rating and a low BTC risk, this spread is tight. If you don't, you're basically waving junk bonds at investors while screaming, "We're building the future." Number 4 is the BTC Credit Hurdle. This is the BTC annual rate of return, the ARR, required to make your credit profile investment grade. If your company can't hit this hurdle, then you're not a Bitcoin treasury, you're just cosplaying as a macro hedge fund while your convertible notes slowly become confetti. It's like saying if BTC doesn't go up X% per year, we're bankrupt. Not a strategy, a liability in a hoodie. So to summarize, BTC rating equals are your Bitcoin bags big enough to back your debt? BTC risk equals what are the odds your lenders get rugged? BTC credit is how expensive is it to borrow against those bags? And BTC credit hurdle, what BTC return keeps the wolves from the door? If you don't model these, you're running a fiat meat grinder with orange branding. And when the music stops, your creditors will be first in line with a calculator and a chainsaw. Let's move on to forecasting, where we start pretending we know the future. And if you're into Bitcoin, you think you know you do. This is the Bitcoin Treasury's version of reading chicken entrails. Except our chickens are probabilistic, volatility adjusted, and denominated in immortal digital scarcity. Let's start with the 3 pillars of Bitcoin Foresight. Number 1, BTC ARR, annual rate of return. This is your assumed annual Bitcoin appreciation rate expressed as a percentage. Basically, how fast do you think Bitcoin is gonna go up? If you're a TradFi realist, maybe you model 15% a year. If you're a laser-eyed psycho, you're locking in 120% CAGR until the heat death of the dollar. But be careful, if your entire strategy hinges on Bitcoin going up 40% a year, you're not forecasting, you're gambling on Saylor's Twitter feed. So model it, stress test it, and for the love of hard money, don't let your VP of innovation set this number. Number 2, BTC volatility. This is the standard deviation of daily Bitcoin returns. Or in plain English, how often Bitcoin reminds you that your stomach lining is optional. Bitcoin is the only asset that can double in 6 weeks, crash in 6 hours, and have CNBC call both normal. If your treasury can't stomach a standard deviation event, well, you don't have a Bitcoin strategy. You have a glorified coin toss with quarterly reporting. High volatility isn't bad. What's bad is pretending it's not high and then crying during earnings calls. Number 3 is BTC price. Obvious, right? Well, not really. This isn't just the current price of Bitcoin. This is the anchor for all your forward projections. Whether you're modeling risk-adjusted returns, credit break-evens, or how many units of fiat clown money your BTC dollar value represents, this is the starting line. Forecast too low and your strategy looks like a monk saving coupons. Forecast too high and you're basically a WeWork pitch deck with a wallet. So yes, price matters, but the assumptions behind it matter even more. Your model should know the difference between a healthy consolidation and a death spiral with influencers live streaming margin calls. To sum it up, BTC ARR tells you what you hope will happen, BTC volatility tells you how violent that hope gets shaken, and BTC price is the number you pretend you can predict so your Excel sheet doesn't burst into flames. This is your cosmic weather report. And if you're forecasting Bitcoin without modeling all all three of these, you're not running a treasury, you're running a reality distortion field funded by witchcraft and quarterly dilution. All right, this is where we turn theory into capital deployment violence. We've forecasted BTC's future like time-traveling monks. Now let's talk about how your treasury actually allocates capital, manages valuation premiums, and weaponizes dilution like a pro, or blows it all trying to time the top. Let's dive in. Number 1, the BTC premium. This is the embedded premium in your company's market cap versus the raw value of your BTC NAV. In English, how much are people overpaying for your stock just because you have Bitcoin on the balance sheet and a CEO who tweets in cryptic riddles? It's like the Tesla effect, but for companies with cold storage wallets. High premium, congrats, you're a Bitcoin proxy ETF with a corporate shell. Low premium, you might want to tell your IR team to stop quoting Peter Schiff. Number 2, BTC Capital. This is the capital you raised specifically to buy Bitcoin. If you're doing it right, it's convertible debt with a 0 coupon and a strike price in the clouds. If you're doing it wrong, it's an ATM facility you activated at the bottom of a bear market. BTC Capital is your fuel. But if you don't track where it's going, or worse, if you burn it chasing press releases, then you're just lighting shareholder trust on fire for a CoinDesk headline. Number 3 is BTC Spread. Now we're cooking. This is the percentage of BTC capital that actually ends up as BTC gain. If you raise $100 million but only end up with $40 million worth of BTC because of slippage, fees, or buying the top like it's your job, you're not stacking, you're simping. High BTC spread means you're efficient, surgical, and dangerous. Low spread, you're just a little clown boy with an accurate case of imposter syndrome. Number 4, BTC parity. This is the price at which a trade results in 0 BTC yield. It's the break-even Bitcoin price where all your dilution, cost of capital, and execution meet up in a depressing little circle and cancel each other out. If you stack above parity, you're generating yield. If you're stacking below parity, you're basically issuing stock to buy vibes. BTC parity is your strategic kill zone. Know it, obsess over it, print it out, and tape it to your CFO's forehead. BTC NAV, this is your Bitcoin net asset value, the total market value of your Treasury BTC holdings in USD. It's your company's raw, uncut signal. Everything else is noise. Your BTC NAV is what you defend with every trade, every raise, every time your CEO goes on Bloomberg and says, "We believe in long-term HODL fundamentals." Number 6 is the mNAV, the NAV multiple. Now, this is where the power laws start kicking in. mNAV equals enterprise value divided by the BTC NAV. It tells you how much the market is valuing your BTC stack per dollar held. mNAV of 1, you're trading at book value, aka you're a glorified index fund with an HR liability. mNAV of 2+, you've crossed the Rubicon. You're no longer a company. You're a financial black hole absorbing fiat into Bitcoin. If your mNAV is high, you can issue equity and still increase BTC per share. If it's low, you can issue and dilute yourself into irrelevance. To summarize, BTC premium equals the hype, BTC capital equals the fuel, BTC spread equals the efficiency, BTC parity equals the break-even sniper line, BTC NAV equals the real treasure, and mNAV equals your financial gravity. This is the treasury game in the Bitcoin era. Play it well or get swallowed by someone who does. Welcome to the final boss battle, BTC Risk. This is the part of the framework that tells you whether your Bitcoin strategy is built like a vault or a cardboard box with laser eyes drawn on it. Because stacking BTC is easy, holding it through volatility, debt, and dilution, that's where most treasuries will lose their minds. Let's unpack the last 2 metrics standing between you and financial ruin. Number 1, BTC hurdle. This is the minimum Bitcoin return you need per year to generate positive BTC dollar income. After factoring in your capital costs, dilution, and whatever soul-draining fiat expenses you're stuck with. Think of it as your Bitcoin cost of capital. If BTC doesn't hit this ARR, your balance sheet starts bleeding faster than your VP of finance when he opens the convertible note ledger. Let me be clear, this is the do not die line. If your hurdle is 18% and Bitcoin does 12, you're not underperforming, you're hemorrhaging credibility and stacking regret. Number 2, BTC breakeven. This is even more brutal. BTC breakeven is the annual return you need just to break even on BTC dollar value, not even counting accounting income. This is where capital destruction quietly morphs into structural failure. Because if you're below break even, it means that everything you've raised, every share you've diluted, every flashy headline you bought with your market cap, none of it turned into net Bitcoin value. You didn't just miss, you built a Bitcoin treasury that creates less than nothing. It's like opening a gold mine and discovering your machinery runs on hopes, prayers, and recycled Elon tweets. Let me say it plainly, BTC Hurdle tells you the return required to survive. BTC Breakeven tells you the return required to matter. Every company stacking BTC should tattoo these numbers onto their financial model, as well as onto their earnings report and ideally on the inside of their CEO's eyelids. Because in a post-fiat world, capital inefficiency is financial treason. So to wrap this whole framework up, if you want to stack without dilution, capture value with torque, and borrow against BTC without needing to wear a clown nose on earnings calls, then you live and die by your BTC hurdle and your BTC breakeven. These numbers don't lie. They don't care about your mission statement. They don't care about how many TikToks your brand posted about financial freedom. They only ask, did you monetize Bitcoin efficiently or waste time and capital pretending? That's the BTC Financial Framework. Hard money, hard math, hard truths. So let's bring it all home. We've just walked through the full anatomy of a Bitcoin native financial strategy. From yield to credit, from capital to risk, from vibes to valuation mechanics. And what we've learned is simple but brutal. Bitcoin doesn't forgive inefficiency, it exposes it. Every raise, every trade, every note issuance either increases BTC per share or dilutes it into fiat cosplay. This framework doesn't care about how good your PR team is. It doesn't care if your CEO meditates with a cold wallet under his pillow. It doesn't even care if the number goes up. What it asks is, did you generate real Bitcoin yield or just inflate your share count? Did you build torque or did you waste capital at the altar of market cap optics? Did you model risk or did you just assume BTC would bail you out while your bonds quietly turn to junk? Because in the new financial order, Bitcoin is the reserve asset, not the marketing stunt. And companies that treat it like a gimmick will get obliterated by those who treat it like a sovereign-grade treasury protocol. This framework gives you a map. It tells you how to extract maximum BTC value per dollar raised, how to issue without dilution, how to forecast returns, track risk, and build a corporate balance sheet that isn't just Bitcoin flavored, but Bitcoin engineered. You don't need to be a crypto company to use this. You just need to stop thinking like a fiat one. So the next time someone asks, what's your Bitcoin strategy? Don't say hodl, don't say long-term vision. Hands them this framework and then ask them if their capital can survive truth. Thank you. My name is Adam Livingston, and if you found this content enjoyable or educational, please like this video and subscribe to my YouTube channel in order to support my work. And as always, let me know what you'd like to hear about going on in the Bitcoin world. Daddy loves you all. Have a wonderful day. Class dismissed.